Here's a bold prediction. By the end of 2026, millions of investors chasing high yield will quietly lose money without even realizing it. JEPI pays a 7.8% yield. Sounds incredible, right? But it captures upside by 35% during bull markets. SCHD pays half that yield and still beat it on total return. High yield isn't always high return. But here's the part nobody talks about. We didn't just rank these ETFs by yield. We screened 5 funds across 4 dimensions: yield, drawdown recovery, Sharpe ratio, and tax efficiency from 2020 through 2025. That's 5 years of real market stress, including a brutal 2022 crash. This isn't a sponsored list. It's a data-driven comparison built to protect your portfolio, not just impress you with big numbers. The first result will surprise you. Before we go further, nothing here is personalized financial advice. This is educational research only. Always consult a qualified financial professional before investing. Tax situations, risk tolerance, and time horizons vary. Past performance never guarantees future results. ETF values can fall. Distributions can be cut. We'll show you exactly where those risks hide in each fund. And one of these 5 ETFs has a risk most investors completely miss. QYLD looks like a dream. 11.4% yield. Monthly income. Simple. But here's what actually happened. Since 2021, QYLD lost 42% of its NAV. Put $50,000 in, your shares are now worth $29,000. Yes, you collected roughly $27,000 in dividends. You basically broke even, while SCHD returned 47% total. High yield masked a slow bleed, and that's only half the story. Drawdown recovery tells you everything about a fund's real strength. SCHD took a hard hit in 2022, but recovered in just 7 months. QYLD, 38 months and still underwater. Think about that, 7 months versus 38. When markets fall, income investors need funds that bounce back fast, not ones that drag for years. SCHD's recovery speed is a competitive advantage most yield chasers completely ignore. $50,000 in JEPI generates $3,900 annually. That feels real. But here's the opportunity cost hiding in plain sight. The S&P 500 returned $8,200 on that same $50,000 in 2025 alone. JEPI's income is capped by design. You're collecting yield while the market runs past you. Is $3,900 worth giving up $8,200? Quick pause. If this research is helping you make smarter decisions, hit subscribe right now. We break down ETFs like this every week. No fluff, no sponsored rankings, just data that actually helps you invest better. Already subscribed? Share this with someone who's chasing yield without checking the full picture. Okay, back to it. Because the next fund has the highest risk-adjusted return of all 5, and it's not who you'd expect. DIVO is the quiet overachiever here. Its Sharpe ratio hit 0.91, compared to VOO's 0.80 over 5 years. Sharpe ratio measures return per unit of risk. A higher number means you're getting paid better for the volatility you're absorbing. DIVO beats the S&P 500 benchmark on risk-adjusted returns. That's rare for a covered call fund. PDI advertises 13% yield. That number is real. But here's what funds the yield, a 28% leverage ratio. When markets drop, leverage amplifies every loss. PDI lost 2.6 times more than JEPI during comparable downturns. You're not just buying income, you're buying borrowed money working against you in a crash. For retirees, that's a dangerous trade-off. But the real yield killer isn't leverage, it's taxes. This is a slide that changes everything. SCHD grew its dividend per share 11.3% annual. QYLD cut distributions twice. Starting with $50,000 in 2020, SCHD investors are sitting on dramatically more income today than when they started. QYLD investors are getting paid less than they were 5 years ago. Dividend growth compounding over time is the most powerful force in income investing, and most investors never even measure it. QYLD's 11.4% yield sounds dominant, but in the 22% tax bracket, tax drag erases 1.2% of that yield annually. After taxes, QYLD delivers just 4.1%. SCHD, 4.1% after tax, with full upside participation and dividend growth. Same after-tax income. Completely different total return potential. Qualified dividends are taxed lower than ordinary income, and covered call funds mostly don't qualify. DIVO holds just 25 stocks. That's it. Technology alone is 28% of the fund. Financials, healthcare, industrials fill the rest. High conviction works brilliantly in calm markets. But 25 holdings means one sector shock reshapes your entire income stream. If tech corrects hard in 2026, DIVO feels it immediately and deeply. It's not a flaw, it's a trade-off. SCHD just changed. The 2026 Reconstitution removed 22 holdings and cut energy exposure by roughly 8 percentage points. 25 new holdings came in. Healthcare, technology, and financials boosted materially. This isn't the same SCHD many investors originally bought. The sector mix and risk profile shifted significantly as of March 2026. If you own SCHD based on its historical behavior, you need to reassess. Here is the uncomfortable truth for dividend investors. The 10-year Treasury is paying 4.3% right now, risk-free. SCHD yields 3.46%. HDV yields 2.94%. BIG yields just 1.59%. Why take equity risk for less income than a Treasury bond? Dividend ETFs must now justify their existence through growth and total return, not yield alone. Only 2 ETFs win on both yield and growth simultaneously. BIG delivers a 10.34% 5-year CAGR with dividend growth of 10.34% annually. SCHD delivers 8.7% CAGR with a 3.46% current yield. Everything else either grows slowly or yields modestly. BYM's 5-year CAGR is just 3.15%, barely above inflation. The blended 5 ETF basket, equal weight across SCHD, VYM, HDV, DGRO, and VIG, produces a net yield of 2.6 to 2.8% on $50,000. That's roughly $1,300 annually. But here's the honest truth. SCHD and HDV do most of the income work. The other 3 contribute growth. Diversification smooths volatility but dilutes yield. Know what you're building before you blend. These 5 ETFs charge between 3 and 8 basis points annually. That's table stakes, almost free. But here's what matters more. A 1.5% annual return gap costs $20,000 in missed gains on $50,000 over 20 years. Fees aren't the enemy. Underperformance is. Choosing a lower fee fund that grows slower costs far more than the fee you saved. Always evaluate return net of fees. The blended basket feels balanced. 5 ETFs, diversified, steady. But look underneath. This portfolio is heavily overweight value sectors and significantly underweight technology. In a market where tech drives most index returns, that tilt has real consequences. You're not holding the market. You're making a sector bet. Value outperforms in some cycles. Tech dominates in others. Knowing your tilt means knowing when this basket thrives and when it quietly lags. 2 percentage points of annual return sounds small. It isn't. $50,000 growing at 10% annually becomes $336,000 over 20 years. At 12.5%, it becomes $542,000. That's $206,000 of difference from 2 percentage points. Every yield trap, every tax drag, every slow growth fund chips away at that number. Here's the bottom line. SCHD wins on income growth. VIG wins on total return. DIVO wins on risk-adjusted yield. PDI and QYLD carry risks most investors never fully price in. Yield alone is a trap. Sector tilts, dividend growth, and drawdown behavior determine whether these ETFs help or hurt your retirement. Always consult a qualified financial professional before investing. Hit subscribe if you want to keep building your knowledge. New investing breakdowns every week, and it costs you nothing